The U. Government spends more money than it collects in taxes and other revenues. This means it has to borrow money to cover the difference. The government borrows money by selling securities, such as bonds, to the public and to other government agencies. These securities are promises to pay back the money with interest after a certain period of time. The government can borrow money up to a limit set by Congress. This limit is called the debt ceiling or the debt limit. The debt ceiling is not a cap on how much the government can spend, but on how much it can borrow to pay for what it has already spent. The debt ceiling has been raised or suspended 78 times since 1960, under both Democratic and Republican presidents. However, sometimes Congress does not agree on whether or how to raise the debt ceiling. This creates a risk that the government will run out of money to pay its bills. If the government reaches the debt limit and cannot borrow more money, it has to prioritize which payments to make and which to delay or skip. This could affect millions of Americans who rely on government services and benefits, such as Social Security, Medicare, veterans benefits, federal salaries and contracts. A delay or default on any of these payments could also have serious consequences for the economy and the financial markets. The U. Treasury market is the largest and most liquid debt market in the world. Investors trust that the U. Government will always pay back its debt on time and in full. This trust allows the government to borrow at low interest rates and makes the dollar a global reserve currency. However, if investors lose confidence in the U. Government's ability or willingness to pay its debt, they could demand higher interest rates or stop buying Treasury securities altogether. This could raise borrowing costs for the government and for other borrowers, such as businesses and consumers. It could also trigger a sell-off in other financial assets, such as stocks and bonds, and cause a sharp drop in the value of the dollar. A default by the U. Government could also have negative spillover effects for other countries and regions that depend on trade, investment and financial flows with the U. It could disrupt global supply chains, reduce global demand and create uncertainty and volatility in global markets. According to some estimates, a default by the U. Government could cause a recession worse than the one triggered by the 2008 financial crisis. It could also damage the U.S. reputation and credibility as a leader and partner in the world. Therefore, most experts agree that raising or suspending the debt ceiling is necessary to avoid a default and its catastrophic consequences. They also argue that addressing the underlying causes of the growing national debt, such as rising healthcare costs and an aging population, requires long-term reforms to spending and revenue policies. What are the options for resolving the debt ceiling crisis and what are the pros and cons of each? The debt ceiling is the cap Congress has placed on government borrowing to pay bills and fund investments. Once that limit is reached, the Treasury Department is restricted from paying certain debt obligations. That would cause the markets to recognize that the Treasury was officially defaulting on its securities.